Brenda Amonyi, and I am the Portfolio Relationship Manager for the Deal Flow Facility. I'll hand over to my colleague.
Thank you, Brenda. Thank you everyone for joining us. My name is Alvin, Investment Officer here at the Deal Flow Facility, and excited to take you through today's session.
Great, thank you, Alvin. And just a brief on who we are. The Deal Flow Facility is a matchmaking, non-investing, and a technical assistance facility. What we do is we help growth stage companies, Ugandan growth stage companies, access capital by linking them to different investors that we have in our pool. And these companies should be able to meet our criteria. That is, like I mentioned, Ugandan companies is one, registered and operating in Uganda, should have been in operations for 2 years, looking for funding of $500,000 and above, with revenue of 250,000, annual revenue of 250,000. So as the Deal Flow Facility, our objective is to increase access or opportunities for companies to access alternative capital. And in the process, we do offer capacity building and focus on investor readiness. And this masterclass feeds into our objective of making companies or informing companies on what they need to do to prepare in order to be attractive for when the time comes, as you look for funding or as investors show interest in your business or the ventures that you're currently doing. So today we will be taking you through financial projections, like I mentioned, the importance of financial projections and how they can help you in this journey as you look for funding. Yeah, so this is the agenda that we will be following today. We will take you through an introduction to financial projections, what you need to understand in your business as you prepare these projections, take you through the key objectives and key performance indicators. We will also take you through forecasting methodologies. And what's interesting is we will have a live exercise to kind of show you exactly what you need to look out for. And then I will take you through scenario planning, how you can present your findings, and then we will have a Q&A. And also just to mention that you're all currently on mute. However, if you have a question, we would like this session to be interactive. Please raise your hand, or alternatively, you can type your question or query or comment in the chat box and we will be able to get back to you. Yeah, so why are financial projections important, and why do we feel as the Deal Flow Facility that it's something that we need to emphasize at the start of the year, especially as companies start planning and going into the year, or as they start their journey looking for funding. We feel that it's important for planning and budgeting purposes. Financial projections guide you or provide a roadmap that you can use to enable you develop budgets and come up with your financial plans that can guide you through the year. Our financial projections are short and long term, so they take you through just beyond the year of operation, and they guide you as you prepare and plan for a forecasted period. For example, it could be 3 to 5 years. It's also important in decision making. So as you work on your projections and look into what your financial position will be in the next years to come, it shapes your decisions on things that you need to do or implement. For example, things around cost minimization. If you are going to launch a new product in the market, what should you look out for? It helps you anticipate, for example, what your sales will be, what your environment is going to be like, what kind of environment will you be operating in. And as such, you make decisions based on those projections, and it guides how your business will operate from that base year going into the next years that you are doing your projection for. The other one is obviously funding, something that I've mentioned already, investors will always look at your financial projections. There's no investor that will want to come and invest into a business without knowing what the next few years are going to be like. They need to be able to anticipate what your growth will be like, or what activities you plan for the next years. And it's not just the private investors. Banks also look at financial projections. So when you're looking for any kind of funding, whether it's from the mainstream banking or from investors, you will always have to present your financial projections. And so that's why we focus on it, because for most businesses, we notice that they don't put so much focus on this. And when the time comes for funding, there's not much that investors can go with to kind of anticipate what the business will be like in the next few years. And also measuring and tracking your performance. It's important for you to sit down at the start of every year and kind of project what your expected business activities will be like, what your revenues will be like, what your costs, your expenses will be like, so that you're able to measure and track how you have performed over the years. For you to know where you are right now, you should be able to know where you're from. And also for any business, you should be able to work towards a certain goal, and that goal can only be defined once you have your financial projections well articulated and well tracked. And also it helps you to identify risks and opportunities. So as you look at the environment, and later on in the slides, we will go through what you should look out for as you make your projections, what assumptions you should work with. You will realize that as you do that, it's an opportunity for you as an entrepreneur to identify what risks will be. And these risks could either be regulatory, things that are beyond your control, or they could be even internal. They could be risks from other players in the market or anticipated new entrants in the market. So when you know what risks you're working with, it's easy for you to come up with mitigating factors, and in a way that protects your business within the period that you're working with. And also opportunities. For example, I mentioned that projections can sometimes help you look at, as you work on your projections, you're looking at the regulatory side, you're looking at your competitors. So then in there lies opportunities for you to, for example, scale up your sales, come up or introduce new products into the market. So projections are really, really important for any entrepreneur who is looking to identify different opportunities for growth, but also for compliance. I mentioned investors earlier, but we know that for example, if your business is a publicly traded company, there are certain regulations and requirements around you presenting your financial projections. So all these are very important reasons, and that's why we insist that for any business that is looking for funding, the first thing you need to do is prepare very well articulated and well balanced projections. Yeah, so I had hinted on some of these items. There are different factors that influence you as an entrepreneur as you prepare and work on your financial projections. They could be internal or they could be external. Internal factors include historical financial data. You cannot know where you're going if you don't know where you're coming from. So you are looking at, for example, how you performed in the last 3 years to give you an idea of how you should perform or how you should expect your business to perform in the next few years. So historical financial data is important, whether it's for sales, whether it's for revenue or the costs you've incurred in the past. All those are very important in helping you come up with your projections for the next years. Your business plan and strategies. As a business, obviously, you have strategies for growth, strategies to scale into different markets. So all these are internal, but they feed into your financial projections. And of course, there are assumptions and estimates. There are assumptions on price. For example, you are assuming that maybe the fuel prices will go up in the next 2 years. So that helps you factor in some of those costs as you run your operations in the business, and keeps you in check without getting surprises as you go along the way. And there are also external factors like industrial trends. You know, it could be a trend around, for example, automation. All the other players in the market are automating. So how do you fit into that particular trend? And it could also be regulatory. What are the regulators saying, and what is happening in the market that can affect you in that particular business? The other external factor is customer preferences. We all know that customers' preferences change over time. Today, I may like the plastic bottle that is circular, but tomorrow the next trend is, for example, an oval bottle or something like that. So you need to be aware of what your customer preferences are to enable you focus on what you will produce to meet their expectations, or the services you will offer them to meet their expectations over the next few years. And also the macroeconomic trends that I had hinted to earlier. So you need to know what's happening in the larger scheme of things for you to be able to know how your business will play into that space, how you will survive, or how you will operate in order to fit within whatever is happening in the economy at that particular time. So right now I will hand over to Alvin to walk us through what you as a business need to understand, and what questions you need to ask yourself, or what areas you need to focus on as you come up with your assumptions towards working on your on these projections. Alvin, over to you.
Right. Thank you, Brenda, for that introduction. Just like Brenda has mentioned, financial projections are a key part of any business, and it's something that you need to take advantage of. It's something that you need to do on a regular basis, because it's very important, just like Brenda said, to know where the company is going and where you've been. And this all informs your strategy, what you will do to get there, the different goals that you will set. And I think this is a timely discussion, as we are still in the early parts of the year. I think many of you have begun setting your budgets, your forecasts, and this is an important part of that. So in this section, we're going to look at what are the factors that you consider when making projections. So remember that projections are just estimates about the future, but these estimates are often informed by information from the business. So as you can see with this table, we have broken down a business into these 4 categories, and these 4 categories should give you a better sense of what your company is about, what products are you selling, what are customers saying about the product, what is your most popular product, how do you distribute the product, how does the product get from you to your final consumers, what are the costs that you incur when producing this product. And so remember that for any projection, it always starts with an assumption. So you always have to assume something, but that assumption has to be based on an in-depth understanding of the business. So, for example, if you start with your market, you need to properly know who exactly does your product appeal to. You need to build a profile of your customer and know that, for example, my product appeals to the younger generation, it appeals to the old generation, it appeals to probably children, it appeals to middle-class working people. So you need to build a complete sense of who your customer is, because you need to know what exactly do they need out of your product. So one, apart from building the profile of the customer, it helps you quantify how many customers are you able to serve. So for example, if let's say you're setting up a company that does affordable housing, for example, and your target market is middle income, sort of working class kind of people, you will know, for example, this is how much they earn on a monthly basis. If you look at Uganda, for example, you'll know that, having done your research, you'll know that there's a certain proportion of the total population that falls within that working class group that you'll be targeting. And then that helps you, one, to be able to price your product, to be able to appeal to your target customers, but it gives you a sense of what the market is like. Is it a growing market? Is there actually demand for this product? Because then, if, for example, you establish that it's a growing market with growing demand, when you make an assumption on things around revenue, for example, you can use that growth rate of the market and apply it to your revenue and say, I can reasonably forecast that, for example, every year, my revenue will be growing by 15% because there's a growing middle class. There's much more people getting into an income bracket that they can begin to afford housing that, for example, I'm providing. So later on in the slide, in the presentation, we'll see the different approaches to coming up with these assumptions and coming up with these forecasts. But it all starts with understanding as many aspects of your business as possible. When you look at the next grouping, which is revenue, for example, you'll get to know that how much are you charging for your products. This is informed by comparing with competing businesses to be able to say, am I undercutting the market? Is my product too expensive? Are people not buying the product because they can't afford it? Do I have room to decrease the price of my product while still earning a profit? What new products can I introduce that are in better demand than one which has a falling demand? So the purpose really of this exercise is to understand all aspects of the business, clearly define them, but then most importantly, quantify those different aspects of the business. So when you look at revenue, you'll have a number. Say last year I made 5 million in sales. This year, what do I expect to make? Am I selling more of a product that is highly demanded, and therefore I expect my revenue to grow more than it did last year? So on top of understanding the business, you need to put it into numbers, because it's these numbers that will then form the basis of your forecast. And another important thing to note is that forecasting is a mix of a science and an art. And so there is not just one number that you're going to use, say, to grow your revenues, but it's a number that is informed by information you've collected, a number that you can be able to defend, but also a number that changes from time to time, depending on the new information that you get. If we look at the last column on cost, you need to understand what does, for example, your sourcing process look like. How affordably are you able to buy the key inputs for your products? And because cost has a great impact on your gross profit, how much you earn off each product, but also the profitability of the business, it's important for you to be able to manage your costs. So you start thinking about things like, am I able to bargain for for lower prices for these inputs? Am I able to buy these goods in bulk when they are cheap, so that I don't have to buy later on when they're expensive? What are your overhead costs? Things like your rent. What are your fixed costs? Things like salaries. And then also breaking down to look at variable costs. Things like, do you pay maybe commissions to your sales agents as they make sales? So it all starts with just being structured and organized, looking at the different key parts of your business, defining them clearly, but also quantifying what that looks like. So we'll look at the next slide, which has a more in-depth example on how we can use our understanding of the business to form the basis of us coming up with assumptions and then building out financial forecasts. Right. So here we have just a sample coffee business. The business really is just one that buys coffee from farmers and then cleans it, packages it, and then sells it off. So on the table, you can see that we have prior revenue, prior figures for 3 years. So we have 2020, 2021, and 2022. And these figures, remember, as we talked about in the beginning slides, historical information forms the basis for you to make projections on the future. So here, if we're just looking at revenue, we can see 2020, we had 2,250, that grew to 3,000 in 2021, and then it grew again to 3,120 in 2022. And then in the breakdown of that revenue, you can see that there are 2 products being sold. That is Arabica coffee and Robusta coffee. So it's important, just like the previous slide where we talked about understanding the business. You need to know, how does this business make its money? What's its revenue model? And from here, you can see that it's basically through the sale of coffee, right? And then if you look down to the cost of sales, you'll see that there's something called coffee purchase cost. So that is the cost that the company pays when purchasing this coffee from, let's say, farmers. And then the other cost of sale is packing cost, maybe putting it into bags and sacks. And then you can see what the total cost of sales comes to, the gross profit and the gross margin. So looking at this example, we'll see that there are sales highlighted in blue. Now those sales, that's where our input is required. That's where we'll make changes. That's where we'll apply our assumptions. And then the rest that are in gray will be areas that are automatically calculated for us. So looking at this business, one of the things that you can sort of use to inform your projections are, one, how has revenue been growing in the past? So you can see that from 2020 to 2021, revenue grew by 25%. Then from 2021 to 2022, it grew by 4%. What people often do is, if you have a large set of historical information, you sometimes can use an average of the growth rate. So in this case, because we just have 3 years, the average may not give you a good, clear picture of really a figure to use to forecast. Because one, you only have 3 years, meaning you only have 2 growth rates, but also the business, there's quite a bit of sort of fluctuation. And so you see that between 2021 and 2022, the business grew in revenue by only 4%. And yet the previous year, it had grown by 25%. So this gives you something to look more deeply into. You need to understand, why is it that revenue suddenly decreased? It grew, yes, but it grew by a very small margin compared to what it grew by the last year. So in that case, then, if you're maybe management, you can find out what happened, maybe to, looking at this example, what happened to Arabica sales? Where are the Arabica sales? Why were they declining? Were we not able to source enough coffee from farmers? Were the prices of Arabica coffee very low? So by understanding the business and really looking at the numbers and critiquing those numbers, it helps you have a more in-depth sense of what was going on in the business. And therefore now you can say, maybe last year, harvests were poor, and therefore we're not able to source enough coffee. And also maybe prices were really low, and that's why for Arabica coffee, the revenue went down and therefore affected our overall revenue growth. So with the numbers alone and an understanding of the business, you combine the two to ask more questions, to find out more information that you then leverage to predict the future. So if you interact with management and they say, yes, the season was bad last year, but this year we expect maybe to double the coffee we collect. We expect that the price is going to increase. Maybe we expect to start exporting some of our coffee, where we're able to lock in prices for our products. That then gives you a basis to say, okay, maybe in 2023, the revenue will increase by 20%. So that's why I was emphasizing that forecasting is really both a science and an art, because you combine information about what you know, but also there are factors that may remain unknown that you cannot factor into your model. So for example, if despite us having or expecting a bumper harvest this season, then there's a sudden outbreak of disease that's affecting coffee plantations, that will reduce our revenue, and we won't be able to meet the revenue growth that we have been forecasting. So as much as it's a planning process, it just helps you identify what are the key risks to the business, for example. And in this case, we have identified maybe a disease outbreak. We have identified things like the fluctuating prices of coffee. And so with further integration of numbers, you're able to build a more complete understanding of the business, which then helps you to come up with numbers that you will use to forecast. So that's just a brief example. Later on, we will go through an example where we really build out the forecast. But this is just to bring home the idea that it's important for you to understand the business and have a comprehensive view as much as you can that then informs what your forecasts or what numbers you will use to forecast whatever business that you're estimating for. In the next section, we'll look at what the key objectives are, because as you're forecasting, you're not doing it just for just. There are key metrics that you're looking at that you will then use to make a decision. So, for example, in this slide, you'll see that we have broken down businesses into the different growth stages. And using these different growth stages, we have pointed out a few of the metrics that you will most likely use or that you will most likely track as you're building out these forecasts. So with a startup, a really early stage business, you'll find that you're looking at things around how much money do we have on hand to sustain the business, because oftentimes you find it's probably the founder that has put in their money and they want to know how far that money can be stretched and how far that money can take the business. So you're looking at things around burn rate, which is the amount of cash that the business is using, the amount of cash that the business uses on a monthly basis. You're looking at things around customer acquisition cost. When you're bringing on a new customer, how much are you spending in things around marketing and promotions just to be able to bring a customer on board? So it's just at this stage that you will say, as I build out my forecast, I won't just focus on revenue, because the business probably has not yet started earning revenue, but because I'm building a product that has demand later on, we can for now focus on just how are we acquiring customers. Does the business have enough cash to sustain its operations? Things like that. And then when we look at a growth stage business where you've probably already built a customer base, you already have a product that you're selling, looking at things around your revenue growth, your gross margin. Are you selling a product profitably? Are you making more than it costs you to produce? Are you able to retain the customers that you're able to sign up for? Things around that. And then when you look at a mature business, one that has really been in existence for a while, you're tracking things around your cash flows, your operating margins. Here, you're really just trying to make the business as efficient as possible. So in whatever situation you're in, I mean, definitely these metrics will change depending on your company and what the objective is. But it's important for you to set yourself up and know what exactly you're tracking as you're building out these forecasts. Because remember, these forecasts are used for decision making. You want to look at, say, your revenue growth and say, we're not growing as much as we should, and here are the strategies that we need to implement in order to grow the business. So it's really important for you to set your objectives and know what you want to achieve as you build out these financial forecasts. Is there any question so far? I think I saw your question, Mr. Deo. The slide is on the previous slide. It's meant to be like that. We're just going to go into a more in-depth slide later on, where we'll have a more built-out example. we just wanted to introduce the concept and then later on just build up on it as we go along. Right. Having looked at really understanding the business and objectives, want to know how exactly do you build out these assumptions? How do you come to a revenue number of 5,500,000 compared to a figure of, let's say, 10,200,000? And generally, there are two approaches to building out assumptions. One is the top-down approach. And with this approach, just as you hear it top-down, it starts off with broad data around things around the economy, things around population, things around your target market, how big is your target market, things around inflation. So it starts out with really general data that we then drill down into and adjust to make it specific to the company. And this method is most used when companies are sizing their markets. So when they're trying to understand how big is the market? Is the market growing? What's the value of the market that I'm operating in? And if you've seen, you usually find it in pitch decks, whereby a company is really trying to communicate that, you know what, we are a company in housing, and this is the size of the market that we are serving. So it's one commonly used to size the market, but then we can also use it to estimate things around revenue. However, with this method, the only drawback is that, one, you need the information to be available. So if you're looking for information on, let's say, if you're operating in a sector that does not have as much research and information done, then you're not able to apply this method because you need to start off with that information, which you then slice and dice according to what your company is doing. And from what you've seen, it's more applicable for large established companies. So for example, in the example that you can see, you will be able to notice that we're speaking about Coca-Cola, a brand that is all over the world, a brand that is fully established. And in one of the ways that they can estimate their revenue is by starting off with the size of the soda market globally. At least they are sure that there's research that has been done, or they themselves have been able to make that research and establish that these are the number of people that take soda across the world, and therefore this is the size of the market. And then Coca-Cola being a big player in that industry, it can estimate and say, we have 50% of the market. Therefore, we can firmly say that of all people that consume soda in the world, 50% of them consume our product, right? So the company at that scale is in position to, one, generate the information it needs, but also to make these assumptions with more confidence because the product is spread across the world, and there's concrete evidence to back up its claims on who are our customers. So from its market share, it's then able to say, if, for example, 10 million people are in the market and we have a 50% market share, we can say for this year, we'll be making 5 million. And then they're also in position to say, this is how the market is growing. The market is growing, let's say at 5%, at 3%. And then you're able to grow that 5 million every year by that 3%, that 5%, to estimate what your revenue will be like in the next year. The other method that is used is the bottom-up method. And this is the direct opposite of the first method that we saw. And with the bottom-up, you really start with information closest to the company, internal information that the company has control over. So in the example, you will see that we're comparing a large company, Coca-Cola, with, let's say, a small up-and-coming soda business. The up-and-coming soda business does not have access to the large information that Coca-Cola has, but for sure it only knows things around, these are my distribution points, these are the number of supermarkets selling my product, this is my production capacity. And starting with that information, you then build up and say, if I have 5 stores that are selling my products, and each store gives me, on average, maybe 1 million, I know that with these 5 stores, each giving me 1 million, I know in total, I'll be able to estimate about 5 million in revenue. So you can see that the small company can only rely on information in its control, information closest to it, while the large company is able to utilize information that has built up over time, but also utilize more general industry macroeconomic information to generate its forecasts. What we have seen in practice is that we will oftentimes use a combination of both. So, for example, for the market, if the information is available, you can size your market using the top-down approach. But then when it comes to revenue, you may be able to do that using the bottom-up approach. So it's really about making a judgment call and seeing, one, what information is available, where does the company stand in the industry, but also what information best reflects what the operations of the company. And so you have to really weigh different options and oftentimes combine the two to come up with figures and forecasts that you can appropriately use. Yeah. Any question at this stage? Any additions from the audience? Anything you need clarification on? Just before we get into the exercises and get into how exactly we can apply these different methodologies, how we can build our understanding of the businesses. Any question? Just feel free to unmute and we'll be able to respond to your questions or get your addition. Okay, great. I guess if a question comes up, please feel free to ask it as we go along. Just like we mentioned, we want this to be a very interactive exercise. And so in this next section, we're going to see how to apply the different things that we have talked about. And we're going to use a few case studies here and there, just to drive the point home on how exactly you can derive your revenue projections, but also how you can derive other forecasts that you need according to the needs of your business. So with this example, we're going to start off with how do you go about projecting your revenue?
Alvin.
Yes, go ahead. Yes, please. Yes, Dr. Henry.
Hello, Alvin. Yes, I think the silence is communicating a lot, that even in established businesses, you're raising very pertinent issues that are overlooked. And it is like, okay, this is the step I might have made or didn't take serious, thinking that this is really very important information that you're sharing, because as an investor and a representative of investors, exactly what we look for. Those are the things that we are going to dissect. It's not the beauty of the pitch deck, but bottom line is what you are actually raising. That I mean, you talk of this mass market. Where is the baseline? What is the benchmark? What did you use? What parameters? What tools did you use? How did you come about it? You know, so I think it's reality sinking in, which I think you should take positively, but I'm really following, and I think you're addressing key issues that we investors look out for. Those are the points where the most beautiful pitch deck goes down the drain. Thank you so much.
Thank you so much, Dr. Henry. Indeed, I think that's a good point that you've raised. And it's good that you're sharing your perspective as an investor and a representative of investors, because once an investor likes the idea at first, yes, you're talking about this beautiful pitch decks, and everyone is saying this, my product is the next big thing. When you come to the due diligence stage, and once you start interacting with the company and the management, these are the questions that you need to be in position to answer, because this creates the basis on which an investor will judge whether it's an opportunity they can take on or not. And so all the things that you say in a pitch deck and all the claims that you make need to have a solid foundation. They need to have a solid basis, because this is really the heart of what an investor goes through when they're evaluating a company. I mean, they'll take on your forecast and then often come back to you with questions just to be able to sense check those numbers and make sure that everything you're claiming is achievable, but also makes sense. So thank you so much, Dr. Henry. We really appreciate the feedback. Right. For this section, just like I said, we're going to have a sample exercise where we project revenue and this different other metrics. So for revenue, what we've outlined a couple of steps that you can take when projecting your revenue. So first of all, you need to start with some historical information. That's why if you've interacted with, even in our own process, we emphasize, can you share with us your audited financials? Can you share with us your management accounts? Because it's this historical information that we're going to rely on to just really sense check the numbers and figure out whether the business is viable or not. So the starting point is historical information. whether it's on a monthly basis and you're building monthly projections, or if it's on an annual basis and you're building annual projections, you need to start with a set of prior records and information. So in this case, you start with your prior revenue. How much did you make last year? Did that grow? What products did you sell last year that accounted for this revenue? And then once you have that historical information, you're going to break down that revenue into your recurring revenue. So that is revenue from products that you sell on a day-to-day basis. Then you're also going to break down that revenue into your one-off revenue. So say, as you'll see in this example, it's a business that sells fruit juice. But if you closely inspect the revenue, most of for 2022, you will see that there is the last item there called training services. So probably training services are them training fellow businesses on how to set up a company, how to sell products, and the company was paid for those services. So in this case, the core products are the juice, which you see they are listed, the mango juice, orange, cocktail, passion fruit juice. But then we also have this one-off item, training services, which you can see was only earned in 2022 and was not earned in 2021, which makes it a one-off revenue item. So the importance of splitting your revenue into recurrent and also one-off is, with a recurring, at least you're able to say, this is really the product that I sell on a day-to-day basis. And I'm confident enough that next year, I'll still be selling the product and I'll be able to earn revenue from that product. But for the one-off revenue, you're uncertain about its frequency. In this year, for example, they were probably contracted to do this training, but you're not sure if in 2023, this training will be done and whether you'll earn revenue from training in the next year. And so oftentimes, if you don't have enough information about the one-off revenue, you may actually omit it from your forecast, because you're not going to say that, okay, next year, I think I'll also get this training. I mean, you can, if you've now made it a business strategy to now venture into training fellow businesses, for example, in addition to the juice that you sell. And in that case, you're able to add it to your next year's forecast. But if you're not, and you admit that, yes, it's a one-off revenue, I don't think it will happen next year, you then focus your forecasts on just the core products that you sell, which in this case, and in this example, are the juices. So it's important to just start off with the steps that we have talked about, collect the previous year's revenue, break it down into the one-off revenue and then recurring revenue, and then try to obtain more information on the one-off revenue. So to understand whether this is something that's going to happen on a more frequent basis and therefore should be adopted into the things that you do as a business. So actually, which brings me to an important point here. You will find that, and from the businesses that we have come across, you'll find that a business reports things like grant income as part of its revenue. But upon further scrutiny, you will see that the grant revenue which is a significant part of what they're reporting as revenue, is a one-off expense, is a one-off income, and it's not something that gives you, so if you're to look at revenue as a combination of the grant income and then the core products and services that the business operates in, it does not give you a clear picture of what exactly is the revenue sort of earning capacity of the business. Because you add, let's say, a grant of, let's say, $50,000 in there, and you report it as revenue, and it will all look good. But when an investor looks deeply into the numbers, such items are often excluded, just to get a clear picture of what the business itself, what does it do and what does it sell? And are these products being sold? Is there actual demand? Is the revenue growing? So that's an important thing to note here. So let's now focus on the core products, which are the juices. Within those juices, you quickly identify which, for example, is your highest, most popular product, which in this case is the cocktail juice, because it brings in more revenue across both years compared to the other juices being sold. Next would be the mango juice, and then orange juice, and then last, which is the least popular product in this case, would be the passion fruit juice. So, for example, if you're now projecting revenue from passion fruit juice, you definitely cannot put it at the same level as the most popular product, which is the cocktail juice. Because one, you're going to ask management, what's happening with this product? Why are the sales so low compared to the other product? You then ask things around what strategies does the business have to either increase sales of this passion fruit juice or to actually exclude it as a product and just sell the other three types of juices without this passion fruit juice. So this informs what you expect the revenue to be. So if the management tells you we are going to do away with passion fruit juice next year, you will definitely not forecast it. However, if they say something around, we plan on doubling our efforts around orange juice, we plan on selling it more, increasing our production of it, you increase the proportion of revenue that comes from the orange juice. So you can see that you look at the numbers tell you a story, but they also give you more questions to ask in order to really get to the bottom of what's going on. And through those questions and understanding what's really going on, you're more confident to say, for example, maybe in the next year, 2023, we'll be able to do maybe 8,000 in revenue. Because you've understood each product, what are the plans for each of the products, and use that information to inform what your projections would be. You've also taken account of this one-off revenue and maybe excluded it from your projections, just for you to give you a better sense of actually what is possible in the business. So remember that forecasting is really an act of balancing where you have to make lots of judgment calls. And so if I say my estimate is 8,000, another person says mine is 9,000, another person says mine is 11,000 for next year. So long as there is a solid foundation for all these figures and we're able to walk let's say an investor through how we came up with these figures, those figures can be justified. So it's not all about having a perfect figure, an accurate figure, but being able to walk a person through it to show them that it's a logical step that you've taken and it's something that you can actually defend, but also most importantly, it's something that the business can achieve. It's important for these assumptions to be realistic and achievable. Right, so with this example, we're now just going to move to the next one. I don't know if anyone has any questions at this point, but we'll move to the next one where we're doing the same really, but just doing it for costs for the same business, but just doing it for costs. So on the cost side, just like revenue, it all starts with just breaking down what those different costs are. In this case, you can see the costs incurred are around fruits, around plastic cups, which make the bulk of how much the business spends in order to sell its product. So here still, you break down the costs and then you identify the key inputs. So for example, if it's a juice business, you know for certain that you cannot make the juice if you don't have the fruits that you're going to use. So the fruits will be a key input. And in order to maximize the profits that you make from the business, it's important for you to control for the cost of these products. So in this case, if the business wants to realize a greater margin, you look around things to do with maybe buying these items in bulk. You will find it has to, if these products are seasonal, you need to buy in bulk and store. You need to establish relationships with your supplier so that you can be able to get better prices compared to your competitors. So the numbers really inform, they paint a picture, but then they also inform what you need to do to realize the gross profit. So I won't delve much into this, but similar to revenue, it's really about looking at the numbers and then asking more clarifying questions, asking deeper questions, just to help you get a better understanding of what's going on, and also to help you understand what informs your forecast for the next year. Please feel free to ask any questions as we go along. Anywhere where you need clarification, just feel free to unmute and share your thoughts.
Okay, thank you, Alvin, for that. Question coming in is around management's involvement. How involved should management be, considering that the entrepreneur or the co-founder of the business may sometimes have biases around inflating numbers to make the business look good? Is this something that can be outsourced, for example, to auditors or to a consultant to cut on the biases that entrepreneurs may have around inflating numbers on the projections?
Okay, thank you for that question. I hope you've all had the question. It was around how involved should management be in developing these projections, because management has a bias to paint the best picture and to really position the business as the best there is, and whether this can be outsourced to maybe auditors or maybe other consultants. So first of all, that's a really good question. And that's something we come across a lot as we are interacting with businesses. So firstly, this exercise cannot be done just by one person. Because if you're just the CEO, you definitely want to paint the best picture of the business. But just like we've been saying, it needs to be as realistic as possible, because there's no use in you painting a very rosy picture of the business, and yet when it comes to actually fulfilling these numbers, you're not able to. Later on, we'll touch on how it's important to always compare your actual performance with your forecasted performance, because that will then show you whether you've actually been realistic in setting these forecasts or not. But what I would advise is that let this exercise be a holistic exercise that is not done by one person or by just one department, but one that takes into consideration those different aspects that we have talked about. If, for example, you have let's say a milling plant, you know that there's a certain capacity you're able to process every day. That already gives you sort of how much, if you are operating at, let's say, 100%, how much you'd be able to do. So you need to take into consideration all aspects of the business, things around sourcing your inputs. How cheaply are you able to source your inputs? Your distribution. You can't tell me if you're selling your product in 2 shops and let's say you're just selling your juice in 2 shops, that you're going to make $10 million in 1 year by just selling through those 2 shops. There needs to be justification behind the numbers. And it's not to say that businesses are not capable of growing, but you need to justify that, okay, I'm saying 5 million next year because one, because of my customers are actually demanding the product. We have the internal capacity to supply this product. We have our sales and distribution channels. This is what we're looking at in the future. So you need to be as objective as possible, because as you set the most optimistic projections, you need to bring them back to reality to be able to say, okay, here I can reduce. This is actually what I'm able to achieve, or with this investment, this is what I'll be able to achieve. So you need to weigh being optimistic and balance it with being realistic, because it's just not all about one person sitting down and doing projections, but you need to involve everyone to sense check your numbers, but also to be able to communicate what is the business doing that will enable it to achieve the numbers that you're putting down. So this can be done internally, and then you'll then sit down with, maybe, if you don't have capacity internally, with maybe an auditor, an accountant, someone who has an in-depth understanding of the numbers, just to be able to really point those numbers and give it a bit of more realistic numbers to that. So I hope I've answered your question. It's not bad to be optimistic, but you need to justify all the numbers. And it's always good to maybe present them internally to see if this is something that the business can be able to achieve. Right. We'll go into our next exercise just to help you really concretize this concept. So this is a cash budget, and just as you know, cash is very important in a business. How you manage your working capital is very important, because that determines whether or not you're able to operate. So I think we'll just probably, if you have a place to write, you can just probably we'll just go through one month, and then we'll be able to show you what the full picture is, and then we'll be able to go through what the different insights are on this. So I think we've all built a cash budget before. This just compares cash inflows with cash outflows to be able to tell us how much cash we expect at the end of a given period and how much cash can the business generate. So think about it a bit like a cash flow statement for the business. So there are instructions on the right that will guide you as you're filling in this. I'd encourage you just to go through 1 month and see whether your ending cash balance corresponds with what we have, just to give you a sense of really what's going on in this business. So the cash sales are given to you, and I'll just go through the instructions on the right. So for this business, 50% of the sales are on credit, and then the other 50% are on cash. And so because it's a cash budget, we'll only be recording the cash sales, the cash that actually comes into the business. So for example, if you look at the column in March 2023, the cash sales here are let's say $1,000. And remember, we said 50% of these sales are on cash and the rest are on credit. So if 1,000 are on cash, that means there's another 1,000 that is on credit, but that is not being received within that month and is received 30 days later. Say, for example, they are selling their goods in a supermarket, in a large supermarket that only pays every 30 days. Then looking at the outflows, we're looking at things around the cost of fruits, plastic cups, rent, salaries, transport. Here, you'll be able to quickly identify that we have fixed costs such as rent that needs to be paid on a monthly basis, regardless of whether you've sold or not. You need to pay salaries on a monthly basis. So those are the fixed costs. Those are the ones that don't change. So in this column, and going forward, we always have a fixed amount for rent and salaries, which has been given here as 500 for rent and 700 for salaries each month. For fruits, we have said the cost is 50% of your sales. So for March, for example, and this is total sales. So remember, here we have only cash sales, which are recording. So total sales are 2,000, and so 50% of that will go into fruits, and then 10% of the sales will go to purchasing plastic cups. We then have transport, which will be 10% of the fruits. So maybe as you fill out on your own, just do for 1 month, and then we'll be able to quickly compare. I'll just, for the sake of time, I'll just go to the next slide where we have the complete picture of what that looks like across these 4 months. And so you'll see that at the end of March, this business has $500 in cash. And then for April and May, it has a negative cash balance. And then for June, it's back into a positive with $200 in cash. We have all, as we all run a business, there are those months where we have experienced what we're showing here, where your cash is negative, where you're waiting to receive from yourself, and yet you have operational costs that need to be paid instantly. So for this, in such a case where you have a negative cash balance, what should the business do? What can the business adjust in order to make sure that it always has a positive cash balance and it's able to meet its operating costs? Anyone from the audience, what can the business do to manage these periods where it has a negative cash balance? What things can he adjust? Remember, we said it receives half of its sales 30 days later, and yet it has to purchase its fruits, its plastic cups, it has to pay rent on a month-to-month basis, whereby it's not able to access credit. So what are sort of those strategies a business can put in place just to make sure it adjusts and has a positive cash balance all through the months, these projected months? Or maybe what are some of those things you have done as a business to help you go through such months of negative cash? Or what have you done to prevent that? Yes, Angela, you can go ahead.
I think the business can try to delay some of the payments to the suppliers.
Mm-hmm.
Yeah, so that's because if you look at some of the costs that are there, that are fixed costs, I'm thinking salaries and rent. Those are items that could be hard to delay. But if you have arrangements with your suppliers for payment of purchase of plastic cups and fruits a little bit later, you can be able to manage your cash.
Yeah, thank you for that, Angela. That's a really good one.
Yeah, we also have a comment from Tadeo, and he advises that you probably need to run away from credit sales because credit sales tend to kill your business.
Okay, great, thank you.
But I just have another side. By the fact that your SME will struggle to attract inputs, especially on credit. If you're importing things from other countries, nobody would want to give you credit for the inputs, for the cups and the stuff like that. So there are two scenarios. Scenario one is the circle of influence, the things that you can influence, and that is what you really work on. So as much as possible, you try to ensure that all your money, if the guys sell, let them collect all the money. If you have the guys who are on credit, who are taking your stock on credit, make sure at least 3 weeks. But if you having the assumption you are saying, you're talking of credit sales of 50%. 50% is a very, very big. Ideally, half of your sales are all on credit. And then you are saying nobody, in the assumption that nobody gives you credit for any input. So you are really breaking yourself. You need to get common ground on not giving out credit. And also the other thing would be, as you build rapport, maybe you can try to profile suppliers who can give you credit. It's hard, but if you started, especially for the daily inputs, for example, for us who are in the middle, we try as much as possible to get suppliers who can give us and collect money after 2 days. That gives us room to pay other people and also have money to keep running. Thank you.
All right. Thank you so much.
I have another version how we can help ourselves with that. Now, under normal circumstances, if you're dealing or if you're offering any credit services to your customers, then you must negotiate for a lower receivable period and a higher payable period. So, for example, if you are dealing in carbs. So meaning that your supplier, you give him a payable period of 30 days, and then your collection period can be 10 days, such that you can collect faster than when you're paying out. So by doing that, you have leverage on your cash flows. Thank you.
Thank you so much, Tadeo. Thank you, Dennis. Yes. Thank you, Angela.
Anastasia wants to speak.
Yes. Someone else?
Anastasia.
Anastasia?
Receivable date. Receiving half in 1 month, it's quite a big amount of days to give to your data. So you must reduce your receivable dates and because you're payable so that you are able to protect coverage to find to maintain the total. It is imperative that you have enough cash all to keep prices low because now with these negative figures, it means a lot of people you need to keep in business. You reduce your receivable but increase your payable. Thank you.
All right, thank you so much, Anastasia. Thank you everyone that has chipped in. And I think you can see the value of this exercise, that even as entrepreneurs, as you are yourselves, these are things that you deal with on a day-to-day basis. These are real challenges that you face. And from our interaction with businesses, you find working capital is really an area that they need support in. And oftentimes, it's not always more financing that is the answer. In some cases it is, but most times you find that there are things that you can change, things that are in your control as a business that you can adjust just to be able to continue operating, to continue selling your products, to be able to pay salaries, pay your rent, purchase your inputs. So I like the points that you all brought about, bargaining with your suppliers for credits, reducing the number of the proportion of sales that you're doing on credit. And it really makes sense. And that is why we want to encourage you to always look at the numbers, let the numbers tell you a story that then helps you ask more questions, and that helps you really understand, why am I in negatives? Why is this so? Well, how have I gotten myself into this position? So it's really insightful, and this is the value of the exercise, and that's why we encourage you to always do this planning and forecasting, because it reveals so much about how you're operating. Before you even go to a consultant or someone external, you as the business have the power to really understand your business, and you really just consult on a few things, but the power is most times is with you to adjust a few things of how you're operating, just for you to get by. So thank you, and that's really the purpose of your exercise. Next, we'll just go into a section on scenario planning, which Brenda will just take us through.
Yeah, thank you so much, Alvin. The next really part of the presentation is around scenario planning. Like Alvin mentioned earlier on, as you do your forecasting, it's always best to assume certain scenarios or certain eventualities. And so sensitivity analysis and scenario planning is really for you as an entrepreneur to sit and anticipate what factors or what changes you expect will affect your business's performance, and how and this helps you prepare for these eventualities. They could be positive and they could be negative. And like you've all contributed just a few minutes back, it's always important for you to anticipate the best and to anticipate the worst and what the ideal situation would be. And that is why there are really 3 distinct scenarios that you need to evaluate your business on as you do your forecasting. The first one is the best case scenario. So best case is normally business as usual. And this really focuses on what your historical performance has been, it's really what your business will be like if everything stays the same and nothing changes. And the other scenario that you can look at is the worst case scenario. Now, the worst case scenario looks at severe outcomes or effects that will happen to your business, or things that you expect that if they happened, your business would be put in the worst situation. For example, you anticipate maybe if you're in the logistics business, you will, for example, in this scenario, look at fuel prices going higher than usual. You're probably looking at things or regulations that you think, if they came into effect, would put your business in a situation that that will not be very ideal. So there are examples around decline in sales and operating costs that we've already gone through. The other scenario is the best case scenario. And here you look at a scenario where your business will flourish beyond. So you are looking at a situation where your business is operating at an optimum level. So you're looking at the highest growth level. You're looking at a situation where your sales will rocket. You're looking at a situation where you will expand, where your operating costs will go to the lowest level. So as you work on your forecast, it's always important to look at these 3 scenarios and assign different values, so that even as you go into your operations, you're able to know and prepare for any eventuality. And as it's and really the benefits of this analysis is something that we've already gone through. It helps you with future planning. So you know, if the worst case scenario happens as a business, you anticipate it, so you prepare for it, and you know how you will then mitigate such a scenario. And then you're also proactive. You know that you need to work. For example, if you look at the worst case scenario, as a business, you're working towards getting to that level. So you're proactive in the strategies that you come up with, whether it's your sales strategies or your operating strategies. You're more prepared, and you work towards avoiding a situation where your business gets into the worst case scenario. And of course, avoiding certain risks that would lead to failure of business. And the next slide speaks to how you can model out the different scenarios, because it's important for you as a business to assign values to the different scenarios. So for example, if we are to choose different factors like revenue and cost of sales, so you choose revenue and cost of sales, and then you look at them from the 3 different angles that we've talked about. So you're looking at the best case scenario. You are maintaining the existing distribution models. You are maintaining your existing suppliers. But in the worst case, then you look at a situation where there's an increase in cost of sales, or there's declining demand, for example, for your product. And in best case, you are looking at a situation where you've increased your distribution mode channels, you are able to bargain with your suppliers, so your operating costs have gone down, or a scenario where your customer base has increased, or where you have, for example, introduced a new product into the market. So when you look at these 3 scenarios and you define the factors that you've chosen to be tested, then you go ahead and you assign different values to them. In this case, for example, for the best case for revenue growth, you can assign a 10% for best case, and 40%, for example, for cost of sales at the best case level. So you assign different values and percentages to each factor in a way that that is realistic and fits within your scenario, or fits within the environment within which your business is operating. And the next table is really to show you how you would present it. So when you look at, for example, the example that is there, 2022, your revenue is 13,650. If your business is to operate at a best case level, then your revenues will go up by 10%. But worst case, your revenues decline by 5%, meaning you're anticipating that if the worst happens, your revenues for the next year will be at 12,000 and not at the 13,000 that you had in the previous year. And best case scenario, where everything is projected positively, your revenue increases by 35%. So then you assign values for all the areas that you are looking to test. And then at the end of the day, you're able to anticipate what your total sales will be, what your gross profit will be, and what your gross margins will be. I don't know if you have any questions around sensitivity analysis before we can move on to the last part of our presentation. Okay, so I think we can move on to how you present your findings.
All right, thank you, Brenda. So just to tie it all up, yes, it's important to do the forecast. It's important for you to do the sensitivity analysis, but even more importantly, it's important for you to really present this information to whoever is going to consume it and the different stakeholders that you'll be involving, whether it's internally and you're looking at it as management, or you're presenting it to your board of directors, or you're presenting it to an investor who's expressed interest to invest in your company. It's important for you to just visualize what you found, visualize your findings, just to make it easy for people to identify the trends that you're talking about, to be able to critique areas that they think you should look out more on. Because, I mean, as humans, we consume information better when it's in a visual format. So other than just listing a spreadsheet with lots of numbers and figures, it's always encouraged where possible for you to add in a few graphs, add in a few text images, text, just to make it more appealing for people to be able to see what you're talking about and spot the insights that you're talking about. In the example here, in the two examples down here, you'll see that it's more visually appealing to look at the graphs compared to the tables, and you're able to see the various trends. You're able to compare periods together. So it gives you a better picture to understand what's going on if it's in a visual format. So it's just as important to do the analysis, but even important because you want to use this information to make a decision, to present it in a format that makes it easy for that decision to be made.
Yeah, thank you, Alvin. There is a question coming in around the difference between a business plan and financial projections, and can they be used interchangeably?
Right, that's a good question. And financial projections are just a subset of your business plan. Because remember, the numbers that you're going to present in your projections are informed by your business strategy. What market are we selling into next year? Are we introducing any new products? How do we manage costs? That kind of thing. So it's just a subset of the business plan, because in the business plan, you talk about your market, you talk about what makes you the best product, how are you positioned in comparison to your competitors. So the projections are just a subset of those, because they are informed by the business strategy that you've come up with.
Thank you, Alvin. I don't know if we have any more questions to ask before we can conclude on the masterclass. Any questions, please raise up your hand or unmute, or you can send us a chat.
Yeah, I think I see one from Tadeo. Yes, we can share a couple of templates. I know there are so many online templates that you can use, but we can point you in the direction of a couple of them. But also we'll be sharing this presentation. It will be up on our website, on our YouTube, that you can be able to refer to it when you need to. But in the communication, when we're sending the presentation, we will be able to point you to some of those resources.
There's someone's hand.
Dr. Henry?
Yeah, thank you so much, Brenda and Alvin. I just wanted to make a quick comment on the difference between the business plan and the financial projections. Definitely, they are related and they are one of the same. That the business plan should incorporate even financials, but the financials should be probably a copy and paste from the Excel or spreadsheet where they were done, and then have the brief into that business plan. Because at the end of the day, what will be requested will be, we need your financial projections and a financial model, and we need the Excel sheet where you develop this model, because financial architects, we kind of dismantle those financials and rebuild them again to see where there is any kind of a loop. Because if you're talking about, say, $200,000, let me give that, and there is a 0.01 error, that already will throw a business, it will affect a business, that error. So we try to check those errors. But also there is something which is always requested from investees, that is the business, that is the feasibility study or pre-feasibility, and that confuses a lot. And because some businesses are handled as projects, so, and also they're in sectors which need specific licenses, we tend to request a feasibility study, and this feasibility study should be the proof that actually that business is viable. But that information can now go into the business plan and make reference to a feasibility study. Some come with a pre-feasibility, and then we can extend maybe financing to the full feasibility if the business is really attractive. But I just wanted to make a slight clarity on that the business plan is the overall document. A feasibility, just pick a little justification for your business and insert it in, and then make reference to the feasibility. Thank you so much.
Yeah, thank you. Thank you so much, Dr. Henry, for your positive contribution always. Thank you for that, and that is very true, and it's something that businesses need to always put into consideration and know that they are different and can be used for different purposes. In the interest of time, we would like to end the masterclass here. If you have any further questions, please reach out to the deal flow facility, or if you need guidance or help with how you can go about coming up with your financial projections, please reach out to us and we'll be able to get back to you. The take home here really is that for any business at whatever stage, whether it's the entry stage, growth stage, or even for mature businesses, it's always important to have financial forecasts, and they should be realistic. So that means you have to keep good records so that even when you are looking at your historical data or making assumptions, they are realistic and not exaggerated, and that these should be tracked and should be tracked. They should be tracked and reviewed on a regular basis. We thank you for taking time to attend the masterclass. We will be having our next masterclass in the coming 2 months, and we will be able to share with you what the masterclass will be on, who our speakers will be, and we will share these invites with you in due course. But also, like Alvin mentioned earlier, we will share a recording, and this can be also easily accessed on our social media and on the FSDU YouTube channels that we will share. Thank you so much, and thank you for your time. Thank you for attending. Have a very good day.
All right, thank you everyone for coming.